looks to me pretty myopic, as if markets are choosing to focus on the green shoots that are there, but they are making the base case pricing very, very la-la land. That's how I would define it at this stage.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Recession or soft landing? Today's guest says that's the most important question for investors to answer correctly here at the start of 2023. The Fed is telling us, don't worry, we got this all under control. And right now, it appears both the stock and bond markets agree with it. On the other hand, there's a growing stampede of macro data warning that a recession, likely a bad one, is unavoidable at this point. Which outcome is more likely? To dig into this, we welcome Alf Peccatiello, publisher of the Macro Compass and former bond portfolio manager, back to the program. Alf, it's great to see you. Thanks so much for joining us late your time from the Netherlands.
Yeah, what time is it? 6:30 p.m. I've done worse than that. Happy to be here.
Okay, that's civilized then. Well, look, Alf, thanks for joining us. And like I said, I want to get into that question, recession or soft landing. Before we do, though, let me just start with the high-level question I like to ask you every time you come on the program. What is your current assessment of the global economy and financial markets?
So financial markets are much more exuberantly pricing in that a soft landing or an immaculate disinflationary episode are the base case. I think that's wrong. You need to respect the fact that China is reopening, Adam. That's the second largest economy in the world. They have pent up stimulus from 2022. Consumers can now finally go around and spend it. They're not locked home anymore. And China is very relevant for global economies. So you need to respect that short-term cyclical growth push. But that doesn't mean that the tightening of financial conditions in 2022 and the delayed effect it has on negative effect it has on growth is not going to unfold. I think markets are getting too exuberant and they're extrapolating that this short-term cyclical growth push means that effectively inflation can come down in an immaculate disinflation episode while we can avoid a recession and everything is going to be fine. And I think that base case pricing is becoming too entrenched and probably it's wrong.
Okay, that's great. I have some questions about China that I had later on, but let me pull them up here and just ask. So I like how you described it, a short-term cyclical growth push from China's reopening here. How transient do you expect that growth push to be? Is this something that's going to be a surge for a quarter or two and then kind of equilibrate? Longer than that?
So I think a couple of quarters is what you need to look at here. Markets care a lot about the rate of change of growth and the rate of change of inflation, Adam. And here, you need to be honest, clearly you are going to be seeing a positive rate of change in growth in the short term. To give you some statistics, there are countries like Germany who are effectively the largest trade partner of China. So the moment China reopens, countries like Germany are going to temporarily benefit from it. Then Korea, Australia, all these open economies that are either geographically close or they have some direct business with China, they are going to benefit from it, temporarily speaking. Because the moment that the growth cyclical push is exhausted from a rate of change perspective, that's likely going to happen, say in 6 months, Adam. You are going to go back into what are the secular drivers of growth. What is the long-term, what I call gravitational pull force. And from that perspective, you are still going south, both on a growth and on an inflation perspective. Now, the market here, Adam, is basically choosing to focus on the green shoots, both on inflation and on growth. So what it's doing is it's saying, look, inflation is going to come down very rapidly. On the piece on the macro compass, I highlighted that inflation swap traders, so the market implied expectations for inflation, are at 2.5% by late summer. So again, I want to repeat that late summer is literally in 7 months. and traders are pricing inflation in the US to drop to 2.5% by then. Wow, that's a rapid decline in inflation. So they're focusing on the good side of it. If inflation comes down, Adam, that's great. It's great because the Fed has an easier life. They don't need to push so hard if inflation really comes down that fast. But they're also thinking that growth is going to be much better because China reopens. And so we avoid a recession. And at the same time, inflation comes down. That's immaculate disinflation. That's a soft landing, effectively a soft landing. And I think that it's a bit myopic to just take the green shoots coming from both angles, because let me give you another angle, for instance. China reopens. We have seen what happens to the supply chains of large economies reopening. That's the US, that's Europe, where you have temporary labor shortage because a lot of people are actually sick by COVID. So you have some supply disruptions. Then you have a lot of nominal growth activity. You have people spending, people consuming. You have the renminbi strengthening as well. So that seems to me like inflationary overall. Commodities are rallying, Adam, as we speak. Copper, base metals, they're rallying. Markets are completely ignoring that as if it doesn't matter for inflation, but they're extrapolating the growth side of it. So again, it looks to me pretty myopic, as if markets are choosing to focus on the green shoots that are there, but they are making the base case pricing very, very la-la land. That's how I would define it at this stage.
Okay. So let me just make sure I caught all that. So the China reopening, it's going to goose growth, economic growth worldwide, primarily, and especially in those countries that have open economies, like you said, that trade with China. You think that's going to be a surge, let's say maybe over the next 6 months, that's going to begin to dissipate. That growth is also going to potentially be inflationary as China's placing more demand on commodities. You say we're seeing some early signs of that already. And you're basically saying the market is ignoring the potential inflationary part of that, just focusing on the growth. It's seeing CPI come down and other macro factors to say, hey, we think inflation's not going to be a problem anymore. So they're kind of writing off whatever impact China might have. It sounds like you're saying that's a mistake. And then we have the, there was the inflation part, and then there was the economic growth part. So, right now, at least, the Fed and the other major central banks are still taking a hawkish stance, and the Fed is saying, "Look, I'm going to get to 5. Yeah, I might get there more slowly at this point, and then I'm going to hold it there, and I'm going to see what happens because we've got a bunch of rate hikes that we've already made, and I got to see the impact that they have on the economy. As there's a delay there, and so once they hit, let's see what they do, and that's got to have a drag on economic growth, right? So I'm kind of curious as to what's going to win out, right? The delayed effects of all the hiking and tightening that have done so far that have yet to arrive versus China's boost. Like which one, on a net basis, are we going to grow? Or are we going to contract as a global economy? And it sounds like what you're saying is the market is just like not even looking right now at the potential effects of what that delayed impact could have, but also if the Fed indeed does hang out, we have a much higher cost of capital than we've had in the past, and that's going to be highly restrictive to growth. I see you sort of reacting as I'm saying this. So it seems like you're saying the markets are really just not paying attention to that right now.
Look, on the macro compass that I released free for everybody, Adam, I looked at market probabilities, because at the end of the day, nobody has a crystal ball, right? But we have to try and extrapolate what markets are pricing and what do we think instead the probabilities are for what's coming ahead. And you're right, because the market is basically assigning a very high probability, 60 to 70%. You can go and read it in the article, how do I extrapolate these probabilities, that effectively a soft landing will unfold. And a soft landing means the Chinese growth push will allow us to avoid a recession, but at the same time, the Chinese reopening will not spur inflation again. So you have basically the market pricing in stuff like Again, we talked about inflation at 2.5%, but then we have earnings growing 4%. It's not very rapid as a growth in earnings, but it's still not a recessionary earnings setup, right? In a recession, on average, earnings drop by 30%. The market is still looking at earnings growing by 4%, mild growth. So we avoid a recession. People are telling me, Alf, but the bond market is pricing a recession. And that's not true at all, because in a recession, the Federal Reserve doesn't only cut rates to neutral. So the market right now is pricing, yes, 200 basis points of cuts over the next 18 months, Adam. That's true. And it's a lot. But that will be reducing rates from 5% to 3%. And trust me, if you get a recession, the Fed doesn't hold rates at 3%. A recession means people are losing their job, inflation is collapsing, profits are down 20, 30%. Sorry, but the Fed doesn't keep rates at 3% in a recession. In an average recession, the Fed cuts way below neutral interest rates. It brings rates to 1%, to 0% if necessary. In a recession, inflation goes to 0%, to negative for a certain period of time. If you look at the past history, over the last 100 years, every time you had a recession, inflation dropped by 7 or 8 percentage points on average. In 2008, people forget that, but in 2008, we entered the recession with inflation, I think, in the 5% area, and temporarily, we went into deflation on a year-on-year basis. And it only took 9 months. So if you get a recession, people are losing their job, inflation is collapsing, companies are seeing their profits slash negative earnings growth. The Fed doesn't keep rates at 3%, guys. The Fed cuts at 0 at that point. And the bond market isn't pricing that. The bond market isn't pricing that inflation collapses to 0. It's pricing a very nice, immaculate disinflation. Back to 2%, the Fed cuts rates, but only to 3%. So back to kind of neutral rates. And most importantly, Adam, credit spreads. Like, guys, I don't know what kind of recession have you ever seen or studied in the past, but there is a chart in the article that looks at high yield credit spreads. It's a very simple chart. It's the spread of lowly rated corporates over treasuries. So it looks at the cost of capital for issuing debt for these junk corporates. The average level of these credit spreads over the last 20 years is roughly 500 basis points. So, if you're a low-rated corporate, you need to pay a premium over treasuries to issue bonds. That makes sense. This premium changes as the economy accelerates or decelerates. And, the more the economy is strong, the tighter the spreads are, and vice versa. In a recession, Adam, these credit spreads are on average 1,000 basis points, 10% over treasuries. It can be 7, 8, 12, depends on the depth and on the rapidity of the recession and how bad it is. Right now, we are at 400 basis points. So again, guys, we are below the 20-year average. How can you tell me the bond market is pricing a recession? The bond market is pricing a very nice and comfortable soft landing. That's where we stand. What do I think of it? I think the recession narrative will prevail because the tightening of financial conditions has been extremely rapid, very, very vicious and strong. It takes time to work through the economy, and it's working its way. The pace of hiring is slowing down. Retail sales adjusted for inflation are negative. They're trending down negatively. So you have signs that all forward-looking indicators are looking at a recession, Adam. So we are slowly walking there, yet markets are choosing to focus on the growth impulse coming from China, ignoring the inflationary impulse potentially, and they are choosing to ignore the big picture, which is the economy is walking into a recession. We're basically pricing la-la land. That's how I would summarize it.
Okay, I'm glad you went to the credit spreads chart, because that was one of the things I was going to bring up here too, that the bond market, just to your point, just doesn't seem worried right now. And we've long said that the bond market is sort of where the smartest guys in the room usually hang out, and you were a bond portfolio trader, back in your pre-Macro Compass days. So it is interesting that apparently the smartest guys just aren't that worried here. So I want to put up one other chart too that you would put either in one of your articles or on Twitter, but this is a it's a tweet you put out. It shows the short dated volume of the S&P as a percent of total volume. So these are basically trades that expire within 24 hours. I'm assuming that maybe then these are options trades.
Yes.
But you're saying here more and more investors are treating the stock market like a lottery, right? If you just look at the growth of this, I mean, it's gone up fourfold in the past, if I'm looking at this correctly, 6 years or so, maybe even more than fourfold in 6 years. So it just seems, right now, like it's a lot of hot speculation. And maybe I'm reading too much from that, because there may be some other reasons why people are taking a 24-hour or less trade. But I mean, this does not seem like something you would see in a market that's conservative.
Yes, and you are now slowly but surely bringing me to talk about our friend Jay Powell, because the chart you just referred to, Adam, is one of the many signs of the fact that animal spirits have not fully disappeared from markets. Yes, we have cleared excesses in a couple of places. House prices in the San Francisco Bay Area are down 30% from their peak, 30% down from their peak. Many unprofitable companies have gone bust. That has happened in the tech space, in the crypto space. So we have cleared some excesses, definitely we have. But now we still have retail investors going and chase these 0 day to expire options, 0 DTE they're called, which are basically lottery tickets, where you effectively overpay for these options and you have them expire in 6 hours. You get your adrenaline shot at the end of the day and try to see if you made money or not at the end of the day. That's one sign of animal spirits. But to take a step back and do it in a more broad way, if you look at the market cap of stuff like Shiba Inu, the Shiba coin or whatever it's called over there, or if you look at the financial condition index more broadly from the Bloomberg or Goldman Sachs financial conditions index, you see that these financial conditions are now as loose, Adam, as they were in March 2022. That's mesmerizing. You have had the Federal Reserve hiking rates by 400 basis points since March, and financial conditions are back at the same level at the very first hike that they did. Can you imagine that? It's market saying, nah, you guys will hike rates to 5%. Nah, we don't care. We don't believe you actually. We're going to just go and buy all the high beta unprofitable stuff. We're going to buy some super volatile altcoins. We're going to push it again, but Bed Bath and Beyond up 50% in a day, Adam. Those are animal spirits. Those are animal spirits coming back. Now imagine you're Jerome Powell. You have a Federal Reserve meeting coming in a week or so. Inflation is coming down, Adam. From a momentum perspective, core services ex housing, so that's like the stickiest part of the inflation basket. On a 3-month annualized basis, it's down to 2.5%. So that's decent. It shows that the sticky components of the inflation basket are slowly but surely coming down to levels more acceptable for the Federal Reserve. Then there is housing inflation. Okay, that's going to take a while. It lags what's really happening in the housing market. There are goods, there are commodities. But the sticky part of the inflationary basket is coming down. So if you're Powell, you could say, we're on the good path. The moment he says that, this market is going to push up 20% in 6 months. Easy. It's going to try and loosen up conditions, animal spirits back again. If you're Powell, there's one thing you want to avoid here, just purely from a risk management perspective, which is a repeat of the 70s, where you relax too early, people say, okay, it's over, mortgage rates drop by 200-300 basis points, and you restart all over again the frenzy where people go out and buy a second house, a third house, they rent it out, they invest in whatever they can. Animal spirits. You want to avoid animal spirits. You want to refrain them. And if you ask me, animal spirits today are already a bit too loose and running hot for what's the Federal Reserve trying to bring down inflation. So I think just from a risk management perspective, Powell will have to do some homework and calm people down, because it's getting a bit too soft landing-ish, la-la land, and animal spirits are back, and you don't want that. Okay,
so that's been the battle that Powell has kind of had all last year with the markets. He trained them, or he and the Fed trained them for, the past 15 years. that the Fed's always going to, add more alcohol to the punch bowl. And he's trying to say, no, it's time to sober up everybody. And he's constantly having to come back out after the Fed releases data that the market finds some way to interpret it as bullish, right? And starts loosening financial conditions because the market gets all euphoric again. And then Powell has to come up, has to tear up his speech and, give the harder language, right? So you're basically saying you expect him to do more of that going forward, and probably even the next week or so when we hear from the Fed again. So you're nodding as I'm saying that, but as we look towards 2023, you've said in the past when I've interviewed you that the Fed is, it's in a fight here for its very own credibility, right? You just mentioned that it doesn't want to have a repeat of the 70s as well, which are two big reasons to say it really needs to be steadfast in charting the course until inflation is well and truly under control. So how do you think the Fed and perhaps maybe the other major central banks are going to act in 2023? Do you see Powell really delivering on getting up to 5 or wherever he's going, and then holding it there for a prolonged period of time, even if, and it sounds like the market doesn't think this, but even if things start breaking because of those high rates?
So in short, I expect them to act stupid. And stupid is basically being late and being, because of incentive schemes, simply being overly tight and not loosening when it's necessary. So let me translate what it means really. My models are pointing to a recession starting in the US roughly in May, April to May. A recession, Adam, is defined as people losing their job, unemployment rate going up, and earnings growth being negative on a trending basis, 6 months over 6 months, year on year. But you need earnings to drop and you need unemployment rate to go up, okay? So that means non-farm payrolls in the 50K area, 0 non-farm payrolls, that kind of numbers, And my models are saying that this is roughly coming around May. Of course, it's an average expectation. I don't have a crystal ball, but that's what the macro compass quantitative approach is pointing to. Now you're Powell, and what you will be doing is probably want to raise rates to 5%. That's what you have already promised to market. So you have to get there, because if you don't, then again, it's going to be animal spirits running over, because people are going to be saying, oh, the guy isn't serious even to getting to 5%. So we can challenge him. So he's going to get there slowly but surely. And then let's say I'm right, Adam, and a recession hits. I think at that point, because when a recession hits, inflation will be coming down rapidly as well. There's going to be a short period, maybe 3 months, where Powell is in denial, effectively.
Okay. And is that expressed by just a wait and see mode? I'm pausing now, right?
Yes. So it's going to be saying okay, we are at 5% by April, roughly. And then we pause. In May, June, we get the recession, the start of a recession, okay? Then what Powell is going to be saying is, nah, guys, come on. I mean, look at the job market. It's still very tight. And people are going to be saying, yes, but unemployment rate is starting to go up. You need to do something. And he'll be saying, nah. In reality, he knows he needs to do something, but he just wants to make sure, really, that inflation is on the right path. It's going to take 3 or 4 months. So you'll have this very weird window where it's very clear that the recession is it, and yet Powell will be just doing risk management, which is, I'm not going to cut rates because I want to make sure that inflation is coming down. That will be a very bad period for markets, if you ask me, because you basically feel the pain. That will be the point where people start to price a Fed pivot, because it's coming. At that point, you know that the proper recessionary Fed pivot is coming. And that's not the Fed cutting to 3%, Adam. It's the Fed cutting to 2 or 1%. But that will be the moment when people realize, oops, if a Fed pivot is coming, it's because we are in a recession. So there is nothing particularly happy about this Fed pivot. It's
right,
earnings
it's not bullish for stocks. Yeah.
So you get credit spreads widening, you get stocks getting hit, you get a 2001 setup, basically, when the Fed cut interest rates by 475 basis points. So people forget that. The Fed cut rates in 2001 during a recession from 6.5% to 1.75 in 13 to 15 months. Earnings dropped by think, 40% or something from peak to trough between 2000 and mid of 2002. And the stock market, despite the Fed had cut already, basically to as low as they could, and very rapidly, the stock market continued to drop from December 2000 to the bottom of the bear market in June 2002 by roughly another 20%. That's despite Fed funds being cut to 1.75, 1.5%. And I think that will be the base case that needs to unfold. This cyclical growth up with disinflationary soft landing as a base case, I think it's way too optimistic, and it just focuses on the green shoot, cherry picking and selectively eliminating the potential dangers. Either that the Chinese reopening is very strong, but then it pushes inflation up, Adam. I mean, I can't believe that people are saying, look, we get these commodities rallying, but it's going to do nothing to inflation. It's going to be fine. Or the other risk, which in my opinion is the biggest risk, medium to long term, is that, yes, you get disinflation. Yes, you do. And the Chinese growth push is going to fade away somewhere in 3 to 4 months. And the recessionary dynamics are going to come back with a vengeance. And you are not pricing those. You're just pricing a disinflationary la-la land soft landing. And I think assigning such a high probability to that outcome, it's poor risk management by markets. It's animal spirits coming back, basically. And I don't think that's...
Got it. And again, we're all talking probabilities here, Alf, yeah. and you'll have a chance to come back on this channel and update us if things materially change in your models. But it sounds like what you're saying is a bit of a head fake the next quarter or two from the China's growth impulse, which then begins to moderate right around the time the Fed hits 5%, and then holds there for a couple of months as we really start to begin to see the recession arrive. Right, we start seeing the earnings fall. We start seeing the layoffs really begin to build further steam, and then it sounds like after that, you think the Fed might say, "Okay, you know what? Like we now think inflation's pretty slayed, and now we're actually kind of worried about what we've done," and so they start easing pretty quickly. They pivot and they start bringing rates down pretty quickly. And I just want to dig in on this. You talked about how in past Fed pivots, they tend to pivot pretty extremely, right? Yeah. Do you see them doing the same here as well? Do you think it's more likely that it's not that it's just sort of a slow progression and they bring it down to 2 or whatever, that you think we might be headed back close to ZERP in terms of their response from here?
So the answer to this is, I think you're looking at a non-negligible probability that Fed funds will be below 2% in 2024. I don't see that as an impossible thing at all. What people do here as a mistake, Adam, is that they mix structural trends with cycles. And that's a very, very dangerous thing to do in macro. So people are telling me, Alf, Fed funds will never be 1.5%, 1% anymore. Impossible, because the inflation picture has changed. Long term, it has changed.
Right. Yeah.
Globalization, onshoring, and all these things are actually there. It's true that those things have, on the margin, changed from prior to the pandemic. People are mixing the time horizons, though, because a recession is a sharp cyclical decline in growth and inflation. And the average recession brings inflation down by 7 to 8 percentage points, Adam. That means that inflation moves from the peak being 7 to 8% in the US to 0. Mm-hmm. In a median recession, historically speaking. The Fed will be looking at that point at inflation at 0%, 1%. Cyclically speaking, it doesn't stay there forever, but at that point, you're looking at that and you're looking at losses in the job market. Why would the Fed keep rates at 2.5%? At that point, imagine you're the Fed. Put yourself in their shoes. You have losses in the labor market, you have an earnings recession, and you have inflation at 1%, let's say. Why would you have Fed funds at 3%? It doesn't make any sense at that point. The mandate of the Fed is labor market and inflation. Well, inflation is below target at that point in the median recession, cyclically speaking, temporarily speaking, and the labor market is falling apart. Why would you want to have Fed funds at 3%? It doesn't make any sense. Actually, I think that cyclically speaking, the market in late 23, beginning of 24 is going to be the reflection of how tight the fiscal and the monetary policy was in 2022. and in 2023.
Got it. And would this be an apt analogy, Alf, because you have followed, Fed policy much more closely than the average person? I think they like to position themselves that they're like a precision driver, right? Where I think, and kind of how you're describing how they've acted in the past, is they much more drive like just turning the wheel all the way to one side and then turning the wheel all the way to the other side. And they're much more of an extreme lurcher than they are this, precision needle threader.
You're right. When you talk to them, and because of my previous job running this 20 billion portfolio, I could speak to some of these policymakers, which is a good experience. So you ask them, how do you think? What's your framework? What's your incentive scheme? And the answer is, inflation target is 2%. I want to make sure I linearly tighten when things are too hot, and I linearly loose when things are not going well. All very controllable. These terms and this, their semantic area that they use is all about status quo, control, credibility. This is the type of words they use. And indeed, if you get a recession, the first thing you're going to be doing, Adam, is bring back rates to 2.5%, level of neutral. That's the first step you do. You loosen immediately policy to what you consider being a neutral stance. But in a recession, neutral stance is not enough. You have to do more. So what they tend to do, because they're always very late in reacting, as they were late in reacting to inflation, they need to lurch very rapidly, as you say. All of a sudden, we got Powell raising rates to 5% and 1 trillion of QT a year, and you pile it up and let's go. You are going to be having the same thing when you have the cyclical downturn. And I know we are humans. We have recency bias. So right now, because Fed funds are at 5% and we are talking about QT, we cannot even fathom the idea that Fed funds will be at 1%. But yes, they will if you get a recession. It's all about cycles, and cycles are a different story than trends, long-term structural trends. Yes, maybe the new average of inflation is 3%, it's not 2% anymore, maybe, but it takes a decade for that to unfold. In a recession, you're still going to get inflation back to 0 or 1%. And as you said correctly, Adam, at that point, the Fed doesn't want to do controllable things anymore. They want to repair, and repairing means an urgency to act. So even if you can't imagine it now, if you get a recession, Fed funds might well be 1% in 2024. Okay.
And obviously, that's going to have all sorts of repercussions for how you allocate capital, but both for the over tightening and then for the Fed massive pivot down the road. So I want to get to that in just a second. Real quick, at the beginning, I talked about how the stock and the bond market, from your perspective, are being excessively sanguine here and not worried. They're pricing in this immaculate disinflation. I love that term, by the way. But you've also written that, if you look at the macro data, it tells a really different story. And you cite a number of examples, but I want to put up one chart here that you've shared, which is the top 10 leading indicator index from the Conference Board. That has a 100% hit rate on anticipating recessions. And that thing basically is screaming recession ahead at this point.
Yes, this is one of the many forward-looking indicators that we study and track at the Macro Compass to try and understand what's the direction of travel for the economy. Now, I think the answer is pretty loud, and it's growth is coming down, inflation is coming down, full stop. There is not much to debate about that. Like, Adam, one of the strongest, most reliable sectors of the economy that is forward-leading is the housing market, for good reasons. It's a very large sector. Actually, the real estate market is the largest asset class in the world. It's largest than stocks and bonds combined. When I say this, I'm like, whoa, that's really big. It is very large. And everybody has, and actually in the US, 80+% of housing transactions are backed by a mortgage. So we're talking about a highly leveraged market, very prone to changes in interest rates. And also a significant portion of the employment. Together with ancillary activities, we're talking about 16 to 18% of the workforce, which is employed in housing-related activities. Wow, a very relevant sector to observe. What are you observing there, Adam? I am observing a leading sector that is completely frozen, like literally frozen. Housing sales down 40-45% year on year, 40-45% year on year.
Yeah, even 50 in certain top markets. Yeah.
Geez, you want to top me up? Sure, 50%. Let's go for it. It's really frozen, and it's frozen because the marginal buyer is cut out of the market. He can't afford it. Mortgage rates are too high. House prices on paper are still too high. Let's talk about the on paper part for a second. KKR and Blackstone are amongst the largest real estate institutional investors in the world. They both have large real estate investment trusts, investment funds, right? So you park money into those and they invest in commercial real estate and housing on your behalf. Blackstone in their BREITs fund has locked people in, basically raising gates for redemptions, not allowing investors to get their money out. So basically you're stuck in. KKR has recently announced exactly the same thing. What does this tell you? This tells you that they don't want people to get out their assets out of these funds, because if they get their assets out of these funds, the KKR and Blackstone are forced to sell their real estate holdings. They need to liquidate their holdings. And there is no buyer at the price that they want to put into their funds. There is no buyer at these prices. So what this tells me is it's a frozen market, and institutions, large institutions, are trying their best not to have to be the first one to offload. This then generally starts a cascade of negative price action. So we're looking at a market which is at best frozen, and I think it's not going to be that way for very long, because it just takes a couple of institutional investors that are forced to sell to then start a negative cascading effect. And this is one of the leading sectors and markets, and one of the biggest markets in the world. So leading indicators, this is just one of the many examples. They're all pointing in the same direction.
Yeah, and I'm glad you picked housing, because it's one I talk about a lot, and I have housing analysts on this program relatively frequently. And you just reinforced a number of key points that we make. You know, housing is priced at the margin, and even in a quote unquote frozen market, there are transactions that just have to happen, right? People die, they get divorced, you know, they get forced to move for some reason or another, and it's those transactions that still set the market price, right? So you can actually, you know, have a lot of, and I think we're seeing this right now, both in the institutional side, as you said, but also on the retail side, where the sellers are trying to just hold steady. Hey, everybody, let's just hang together. Let's not sell at these prices, right? Let's protect all our market value. But there's a first mover advantage to bolting. And when those marginal prices, marginal transactions start to begin to bring the price down, you're going to have, you know, either some distressed sellers or just somebody who doesn't want to be caught holding the bag, get out, you know, use that as their point to get out. And then everybody's going to start chasing that market down. Right. Yeah,
that's exactly how it works. So the best possible outcome for these large institutional investors is that nobody has to be a forced seller, but that doesn't work. There's always somebody that has to be a forced seller. And when it goes, then there is a second mover advantage, which is, wow, it has started. I need to get out now because I can't wait anymore. And that then reaccelerates in a vicious circle, actually, the move down in prices. The housing market has always worked like that. It's a lagging market in terms of prices, but it's a leading market in terms of telling you what's the state of the economy. If the housing market is rebounding, then it means the economy will be doing probably better in 6 months. The housing market has come to a complete halt for the last 12 months. And it's just one of the many leading indicators pointing to the very same direction. Growth down, inflation down.
Yeah, and one thing I will say is different this time about the housing market is, at least on the residential side, is there's so much more institutional ownership in the residential stock than there used to be. And so if you have any of those players get into trouble, they have the potential to dump a lot of inventory on the market, you know, all at once. So it could really be a catalyst to a downward cycle. I'm not saying that exactly is going to happen, but the risk of that happening is certainly a lot higher now than it was in the last market downturn, just because we didn't have housing market downturn, because we just didn't have institutional penetration like this. The other thing that's important about housing, as I know you know, Alf, is it's much more widely owned than financial assets are, at least in the US, right? The top 10% own like over 80% of all the financial assets that are out there. So whatever happens in the stock market is influential, but it's not that relevant to the average American. What happens to housing is a lot more relevant to a lot more Americans. So if people start seeing home prices coming down, they then curtail their spending. There's a negative wealth effect that's associated with that. And if that gets paired with job layoffs, which you've said you expect to see come back in the middle of this year with a vengeance, that's like another barrel of the shotgun that's going to tighten consumer spending. And of course, consumer spending is 70% of GDP. So, this all can really start a negative snowball effect in terms of, economic growth, or in that point, probably economic contraction. You're nodding as I'm saying all this. The last thing I want to say about housing, just you talked about I was shocked to hear the stat the other day about the Bay Area, San Francisco Bay Area being down 30% from the peak, which was last March. I live in the Bay Area, and prices here have gotten stupid. I'm surprised the median price is down that much, just because I'm not visibly seeing price corrections that much yet where I live. But this is sticky, and it takes a little while for this stuff to really propagate. We're beginning to see markets that are really showing price declines like that. Like, it doesn't, people have been saying, there are a couple of markets that maybe got a little hot that have now kind of cooled off or flatlined. You can't ignore a 30% decrease in median price in less than a year, right? But also KB Homes, which is one of the largest home builders in America. You might have seen this, Alf.
Yes.
They just announced that their cancellation rate in Q4 was 68%. That was up from something like maybe 15% a year prior, right? So 2/3 of the contracts that they had entered into to have their homes bought got canceled by buyers, right? I mean, that just shows you, to your point, that is a market where the buyers they're just going on strike right now. And that builds because, once people start seeing the price declines, especially from the stupid heights that they've been at, well, nobody's going to want to stretch anymore to get into a house because they don't want to catch the falling knife. They're just going to wait, right? And the more people that step back and wait, the less buying pressure there is, and the more gravity begins to play on these prices. So, I think housing is really going to be an important leading indicator here, like you've been saying.
Adam, I think you're an excellent macro analyst.
Yeah. All right. Well, look, if there's room for me at your Substack, I'm heading over there. All right. Well, let's now shift to kind of where the rubber meets the road. You've given us great macro outlook here. I know, Alf, that you manage portfolios, public and otherwise, based upon your macro views. So I'm curious, where do you see the markets going from here? I'm going to guess you're going to say the bottom of the bear market that started last year is probably likely not in. And so if that's true, how much downside do you think is left?
The bottom is not in, I would say. This is, again, my base case. I've been wrong plenty of times, might be wrong again. But my base case is that the bottom for equity markets, surely credit markets, housing markets, is not in at all. This is my first answer. And when I look at potential for drawdowns, my base case is for the S&P 500 to probably trade in the 3,400 area. The reason why not lower is that earnings and valuations almost never bottom at the same time, Adam. So if you get into a recession, which is my base case, then earnings have way to go down from here, 20-30% historically at least. But valuations at that point would probably not collapse further, because when you get that kind of earnings recession unfolding, as we discussed, ultimately the Fed caves in. When the Fed caves in and brings Fed funds to 1%, over time, it's reasonable that valuations at least do not contract anymore. Let me put it like that. So earnings and valuations never bottom at the same time. That's why, despite expecting a very large decline in earnings, I think the S&P has way to go down. I mean, 3,400 is like 20% plus from where we are today. So there's quite a drawdown yet to go. But still, I would like people to remind that earnings and valuations never bottom at the same time. So it's a bit complicated to see the S&P much lower than that. Okay. And while you were talking, I put up the chart that you had put on in your report recently that showed that lag, or showed that prices recover before earnings do. I just want to add one element to it, which is in past rate cutting cycles, when the Fed has pivoted, the markets usually have taken a quarter or two to recover
once the Fed started the pivot. In other words, you don't have the pivot announced and then the markets go off to the races usually.
That's
you have the pivot
correct.
announced, you have these really bad conditions, stocks continue to worsen for a while.
Yeah.
So we're gonna see, basically, I'm just trying to get the progression right. So we'll see the announcement of the pivot, then a quarter or two later, we'll see the bottom in the stock market, and then a quarter or two after that, we'll see a bottom in earnings.
Yeah, actually, that's the correct progression. Actually, this time is, I'm going to be saying something heavy. This time is different, very expensive words in finance. But
Bold man.
why I'm going to be saying that is, we talked about the stubborn and late to the game Powell. So this time, you're going to be seeing the earnings recession coming in, at least in my base case, pretty evidently. And still, you're going to have that period, very negative for markets, where Powell is going to refuse to cave in. So there's a period where earnings keep dropping, and you see the recession is evident. It's here, job market losses, earnings recession. Historically, the Federal Reserve would pivot. Not immediately, but maybe after 2 to 3 months max, Adam. And this time, I think this period can be a bit longer because Powell is going to have some restraint to cave in rapidly. So there is a period where for markets could look pretty bad, 4 to 5 months, where recession it becomes clear, but Powell takes time to pivot. It ultimately does pivot. He does pivot, and still historically from that pivot onwards, there is another 3 to 4 months, as you said, until valuations can finally bottom, and also the S&P can bottom with it. So I think it's hard to look 9, 12 months ahead, but between now and maybe the next 7 to 8 months, you still should expect the bottom to be ahead of us and not behind us. And then there is the bond market, which is interesting because one thing I'd like to say to people is you are paid to wait. You have a luxury that we haven't had in 20 years, basically.
Right.
You are literally paid a 4.5% risk-free short-term interest rate by putting your money and parking them into money market funds, into some short-dated ETF that replicates T-bills, by simply buying T-bills, whatever you want to do. But basically, you're insured a 4.5% yearly risk-free return at the moment, annualized. To wait, I mean, that's incredible. It's basically having optionality of looking at these very turbulent market conditions, Adam, and trying to assess where it makes sense to deploy capital. That's an optionality for which you normally pay. You are not paid for options. And now you have an option. You can just stay out, at least for a portion of your portfolio, and get paid to wait and patiently assess where the macro landscape will bring you. That's incredible. I'd use that optionality, I think.
Great. So that's exactly where I was headed. So from a stock standpoint, just to quickly reiterate, make sure I clearly heard you. Your base case shows the Fed basically pausing around May, right? You're then going to have that extended period where we begin to see the worsening of the recession and whatnot. So stocks will be probably not performing great from that. You said that could last, I don't know, 3 to 5 months, whatever. Yeah. Then the Fed sees how bad things are and it pivots, and then you still have the drift down towards the bottom from that. So stocks may not bottom till turn the year-ish. And I realize we're talking far enough out that we need to have you back on, long before to give us an update. Bonds, though, you're saying, hey, they give you a chance to get paid to wait to see what happens here. And presumably certainly when the Fed pivots, but maybe even when the Fed pauses, the bond market will likely respond well to that because people know that the tightening and the hiking are kind of ending, and that should be correct, interpreted as positive for bonds. So basically my point is bond prices should probably, if they're going to respond favorably, they're going to do it way before stocks do.
Yes, you are not only paid from a yield to maturity perspective to wait, so you lock in that yield and you're paid that yield to wait, but on top of it, you have a potential price appreciation when the bond market smells that the Federal Reserve is about to pivot. Because if it's true that the stock market doesn't immediately rally when the Fed validates the recessionary pivot, the 2001-like pivot, the bond market does, because that gets immediately reflected in bond prices. When the bond market smells that the Fed is about to do a recession-like pivot, cutting rates to 1% or 2%, that needs to be reflected in bond prices. So in 2001, again, that's your example, your roadmap, Adam. 10-year treasuries in total return basis rallied 10% for the entire year. So by investing in treasuries, summing up your coupons and your price appreciations, you made 10%. That's because the Fed cut rates and the market had to embed these rate cuts into bond prices. The S&P dropped by 12% that very same year. So that dichotomy between bonds and equities, I think it's something that will come back to the table in 2023.
Okay, great. And I think that's a big opportunity for investors to be really watching closely here. Based on your expertise in the bond market, Alf, how attractive is the opportunity in bonds right now, just on a historical basis? And I'll preface this by saying, I have talked to some analysts on this program who have said it looks the most attractive they've seen it in their lifetime. I don't want to put those words in your mouth, but are we at that kind of level of opportunity here in bonds, or would you make it more moderate?
I think that October, November, actually October last year was incredible. You could buy 5-year treasuries at over 4%. That was pretty decent, I think. Right now, I think the risk-reward opportunity in front-end short-dated bonds is extremely attractive, as we discussed. You get paid 4.5% to wait. It's beautiful. And I wouldn't really pass on that opportunity. On long-dated bonds, they of course already discount 200 basis points of cuts by the Federal Reserve. They do discount that. Now, Adam, we discussed the fact that my base case is a recession. In a recession, the Fed cuts rates by more than 200 basis points.
Right.
Cuts rate by maybe 300-400. So as that needs to be priced in bonds further, there is upside. But again, it's risk-reward. I might be wrong. If I am wrong, then the potential to lose money from a price perspective in bonds at these levels with 200 basis points already priced in, let me say it's not the best I've seen in my lifetime. At least let me put it like that.
Okay.
But it is an asset that I favorably look at, especially compared to equities or credits or housing, definitely, and especially the shorter end of the bond market. Because if it's true that perhaps the Fed doesn't cut rates by 400 basis points, if we are going to slow down on inflation and growth, no way the Fed is going to keep rates at 5% for another 2 years, Adam. That's not going to happen.
Right. Okay, great. And I'm just curious, on the longer end of the curve, let's say the Fed does only bring rates down by 200 basis points. Those bonds wouldn't really lose money in that case. They just wouldn't have the upside appreciation that we would normally expect to in a normal cutting cycle.
Yeah, yes, in principle. There is only one problem, which is the curve might steepen. So what happens is, if you really have this soft landing scenario unfolding, let's say that really realizes, what happens is the Fed cuts rates to 3%. As you say, that's already priced in, so you don't lose money from that. It's there. But what happens at that point is, well, if we have avoided a recession and now Fed funds are at 2.5%, Adam, then maybe the economy can keep growing again. And as it does, it gets reflected into the back end of the curve and the curve steepens. So over time, you might lose some money because land unfolds and the cutting cycle was already priced in your bonds. So you don't get a tailwind from that. But maybe the reacceleration of the economy actually hits you a little bit. Again, the risk reward is not bad at all. So I'm not saying I don't like long end bonds.
Right.
That's not what I'm saying. I'm saying from a risk reward perspective, it looked amazing in October. It looks okay now. If you expect a recession, certainly it looks okay. The front end, like 2-year bonds, those look more attractive from a risk reward perspective because the ability you have to lose money there, it's pretty limited, if you ask me.
Okay, got it. And I'm going to wrap things up here, but real quick. You talked about sort of the scenario, if it were to happen, which you don't think is the likely outcome. You've got some risk there. What about the breaking something scenario?
Ooh.
Right. So we talked about a Fed pivot because of a recession, but what if that is coincident with something really bad breaking, maybe even forcing the Fed's hand before later, as late in the year as you think? What does that do for bonds?
I have to say that isn't a low probability scenario for basically one main reason is that the Federal Reserve will be shrinking their balance sheet by over $1 trillion a year.
Mm-hmm.
Trillion a year. And people seem to be ignoring that, or people told me that the reverse repo facility is going to sterilize the QT. That doesn't work because money market funds can only invest in bills. They cannot buy bonds that the Fed isn't buying anymore, Adam. Money market funds are limited by guidelines to invest only in 6 to 12 months T-bills. So unless the Treasury all of a sudden only starts issuing bills, which that management strategy doesn't change overnight that rapidly, Adam. The US Treasury is going to keep issuing 3, 5, 10, and 30-year bonds. And money market funds cannot buy them. It's very simple. They just can't buy them, which means QT is going to shrink the Fed balance sheet and it's going to shrink bank reserves, which are the interbank liquidity. This is money for banks. This is what oils and lubricates the financial system. These are going to be coming down very rapidly. When they come down very rapidly, there is one thing that generally doesn't hold very well, which is the repo market. The repo market is a market that needs lubricants, and banks are amongst the largest actors. The more reserves they have, the more they support the repo market. The less reserves they have, the less liquidity they have, the more likely they are to just pull back. Do you remember 2019 where we had that sudden spike? Why? Because the Fed was doing QT for already 1.5 years at a slower pace than today, by the way. Now we are looking at a very, very rapid pace of QT. And Waller released an interview. It's a Fed governor, and he doesn't seem to be impressed at all. He wants to keep going. So there is a chance that this diminished liquidity where the Fed doesn't seem to cave in can create some trouble in the repo market. If that happens, there is no other way around. The Fed has to step in. The repo market underpins the largest market in the world, which is the functioning of the Treasury market. It cannot stop working. It's very simple. It cannot. And the moment it does, the entire financial architecture is in trouble because the base of the pyramid, the market underpinning the most liquid, risk-free, most traded asset in the world, which is treasuries, doesn't work. And that can't be allowed. So the Fed will step in if that's the case.
Okay. So I would just say, to put it in context for investors, that would be probably not good for stocks. And that would be probably very good for long-dated U.S. Treasuries because you get a crisis trade going in there as well.
That's true.
Yeah. Okay. All right. Great. Well, real quick question I'm getting to next, Alf, is where should people go to follow you and your work if they've enjoyed this fantastic discussion that you've given us? But real quick, we talked generally about stocks and bonds, but as you are looking to portfolio allocations, are there any other particular assets you think are worth talking about real quickly in terms of whether you're adding to them in your portfolio or removing them? And for one example, I know we've talked about gold a little bit in the past. I'm not trying to lead with gold, but if there's any other asset like that you think is worth talking about before we part here.
I think base metals are very interesting, talking about commodities, because when you hear me talking, of course, I laid out my long-term macro view, but I'm an investor that also looks at tactical opportunities. And so when China reopens, Adam, obviously it's a big push for these base metals. I mean, China needs and uses large amounts of copper, zinc, aluminum, and all these guys, right? So I think even if it's contrary to your long-term macro view, you need to be nimble. You don't need to have an ego. And if China is reopening and it is supportive for these base metals, on a short-term perspective, why not having some in your portfolio, for example? That goes to show again that in macro investing, there is no space for being attached to a certain narrative. You have to have a data-driven framework, an approach, and be able to really identify short-term tactical trends, long-term cycles, and mingle them in your portfolio management approach. I think base metals are a good example of a short-term, decent risk-reward potential here.
Great. All right, 2 questions on them then. Are you investing more in the actual commodities themselves, or are you investing in, miners?
That's another lesson I learned very hard when running money. Do not, if you can, avoid proxy trading. Proxy trading means you have a brilliant idea, but instead of expressing that idea, you look for something that looks very close to that idea. So in that case is you like base metals, right? For instance, so you like copper. And instead of buying copper, you go and buy Chilean peso because Chile is a large exporter of copper, right? That would be exactly proxy trading. And risks are very high and rewards are normally not super high from doing this. So I would rather stick to the commodities themselves if I need to choose.
Okay, great. And then are there any particular base metals that have your focus right now in particular?
Yeah, I think everything that China is a large user of. And I put the chart on Twitter. I mean, copper is the general suspect, but also steel, aluminum, zinc, nickel are all base metals that China consumes and uses a lot. In some cases, China accounts for over 60% of global demand in these metals. So we're talking about like a large buyer coming back online.
All right, great. Well, look, Alf, thank you. You've given a ton for our viewers to go research and dig into. This is exactly the type of interview that I created Wealthion for. So thank you for delivering such a great discussion here. All right, now final question, which is for folks that have really enjoyed this conversation, maybe learning about you for the first time in this interview, where can they go to follow you in your work?
They can go to themacrocompass.com. That's the website where they find all the products that me and my team offer. I have managed a $20 billion portfolio in my previous life, and I've decided to just step back from banking and make sure that I can share my data-driven macro approach, portfolio trade ideas, and much more with you guys at the end of the day, because in a bank, I couldn't, and now I can. And all of that, if you enjoyed this interview, this was a very nice appetizer of all the analysis we try and run on the Macro Compass. So that's it, themacrocompass.com.
Okay, great. And you have a phenomenal Substack, which people can find out about on the macrocompass.com. Highly recommend people check that out. And Alf, you're very active on Twitter. You're one of the guys I follow daily. What is your Twitter handle?
@MacroAlf. And on Twitter, you'll find snippets of macro here and there, commentary, charts, occasionally some pizza and pasta pictures. I mean, I'm Italian after all.
From a true Italian, even though he lives in the Netherlands right now. All right, Alf, well, look, in wrapping things up here, you do a phenomenal job of helping educate people where the macro puck is going, and then give them, specific market opportunities to look at and consider. A lot of people have regular lives, and that information is super useful. But in terms of like, okay, how do I manifest that advice in my particular portfolio? Something that I recommend that people do on this channel a lot is work with a good professional financial advisor who follows and understands all the macro trends, risks, and opportunities that you talk about, Alf, and then makes it personal for the investor themselves to say, okay, for your specific situation, your goals, your risk tolerance, et cetera, I think this is a good way to implement it, right? A lot of people don't have the bandwidth to do it themselves, maybe don't have the experience to do it themselves, which is why I recommend that people work with such an advisor like that. Folks, if you've got a good one, great, stick with them. Subscribe to Alf Services, share that information with your advisor and say, hey, make sure you're taking this into account with my portfolio management. If you don't have a good advisor like that, or would like a second opinion from one who does, consider talking to one of the financial advisors that Wealthion endorses. You can set up a free consultation with them. It doesn't cost anything. There's no commitment to work with them. They just offer it as a public service to help people make more intelligent decisions around their money. If you want to set up one of those consultations, just go to Wealthion.com and fill out the short form there. And folks, if you've enjoyed having Alf on this program as much as I have, and I've enjoyed it a lot, please help us get Alf to come back to this program by supporting this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Alf, my friend, thanks so much for coming back on the channel and giving us such a great discussion. It's always such a pleasure when you're on.
Adam, thanks for inviting me. And I cherish the work that Wealthion has done. You have really helped a lot of people get a better understanding of macro. You have fantastic guests. You're a great analyst yourself and a great host. So keep it on.
Oh, you're very kind, buddy. Mutual Admiration Society. Thanks so much again, Alf. Everybody else, thanks so much for watching.